Hey guys, welcome to the Two Docs Podcast. I'm Dr. Ingky.
I'm Dr. Ali here, and we are two doctors who don't really talk much about medical stuff on a weekly basis on our podcast. We talk about any kind of other issues, up-to-date stuff, even backdated stuff. So we'll talk about it. Right, so we were talking about fighting inflation, or stretching inflation, last week, and we're going to do another series on sort of like a bit of finance. I think it's about investing.
Yeah.
Now, I'm not a savvy investor. I'm a bit of a lazy guy. So, do you have any tips for a lazy person to invest?
Yes, there is actually a term called lazy investor.
Lazy investor?
Yeah, a lazy investor.
I like that.
Now, the reason why there's the term called lazy investor is because a lot of people are not very sure how to invest. And because when you ask someone, how do you invest, right, there's like, 101 ways to invest.
Yeah.
And people actually get a little bit confused.
It's so much of jargons.
Yes.
So much of jargons.
And,
it's confusing.
And a lot of times, right, people don't have the time to do research. They don't have the time to manage their whatever portfolios or their investment. Yeah. And a lot of investment actually takes up a lot of time.
It's a full-time job.
Yeah, it's a full-time job. Much, and if you have a full-time job, let's say, like Ellie here himself, he's a doctor, he travels, he has surgery. So all the money is just sitting in the bank, right? He has a lot of money, it's just sitting in the bank. So the money, if it just sits in the bank, inflation eats it up, chips it away slowly but surely. So it's always better that he puts it somewhere. But of course, where to put, all right? How to put. So the term lazy investment came out, right? Now, just a trivia, just want to ask you trivia, right? Property investment. Do you think it falls under lazy investing? Okay, I give you guys a definition of what lazy investment is. Lazy investment means that you can put your money into an investment vehicle or anything, put it in, don't need to look at it at all, right? Don't have a look at it at all. You only look back at it after 10 years, all right? So, is property considered as a lazy investment?
I think it's a yes and no.
Why is it a yes and why is it no?
It's yes because it's good for 5 years.
Okay.
It's no because anything after 5 years, it doesn't really appreciate as much.
Yeah. So actually property is not a lazy investment because property requires a lot of managing. A lot of people don't understand. A lot of people think that, it's very easy. I just buy a property. Let's say it's a rental property.
Rental is not.
Rent it out.
Rental is not. Rental is a lot of work.
A lot of work. Yes.
And sometimes you don't make back that money.
You don't make back. Sometimes you have a lot of issues with tenants, right? Tenants defaulting, tenants damaging stuff. And even if, let's say, you're not renting it out, right? You bought a property and you left it there. There is still things that you need to do, right? There's still some licensing. You still have to pay certain fees, right? From time to time, you need to upkeep the property. So property is not really a form of lazy investment. So lazy investment means that you just put it inside.
Don't think.
Either you leave it inside or someone manage it for you.
Okay.
All right. So for me, I have 3
lazy
investments. All right. I would say you pick and choose which one is your cup of tea.
All right.
Now, of course, disclaimer: none of us are financial advisors. None of us are financial advisors.
We just do and we get by.
So lazy investment. One of the downside is it's very long to see your fruits of labor. And the returns are actually low, very low.
You're not going to make a career out of it.
No, you're not going to make $1 million out of it, right? So you won't strike rich from lazy investment, but because it's safe. All right. The reason why it's lazy is because it's safe. All right. So the first one is unit trust.
Unit trust.
All right. So what is unit trust? Unit trust is when a group of people pool their money together.
Okay.
Right.
So lots of people put in a bit of money.
Yeah. Everyone put in a little bit of money.
$100 bucks. Okay.
Chips in.
All right.
Okay. Then then everyone just puts a little bit of money and it fills up the cup. All right. Then you hand it up to someone.
So everyone has a share.
Everyone has a share in it. Yeah, you hand up to someone.
Okay.
This person is generally a professional investor or a banker. They will take the money and then go and invest for you.
Okay.
All right. So that's what unit trust is. Now in Malaysia, we have something similar. It's called amanah saham.
Yes.
All right. Amanah saham. Amanah saham.
It literally means it's unit trust.
Yes. Yeah. Amanah saham literally converted. It's unit trust.
Literally means unit trust.
Yes. So what you do with an amanah saham or this unit trust, and if not mistaken, it's backed by the government. Yeah, it's backed by the government. So it doesn't really collapse, right? So what you do is you put in as much, however you want, right? I think the minimum is like 300 ringgit you put in. Really.
Correct.
Yeah.
Correct.
You put in 300
the entry is very low.
Entry is very low. All right. then of course you have to take in consideration their service fee and their commission after the deduction of it. Then you leave it there. Now, Amanah Saham generally gives you a return of anywhere between 4 to 8% per year.
Okay.
It's not
Fair.
It's not
It's
big.
fair. It's not great.
Yeah, it's not great.
It's not great, but it's
It's
fair.
fair. It's fair.
It's a very
right?
fair deal.
At least it helps you, number one, in a form, save money.
But Amanah Saham is a bit like share. The way it operates is like share.
No. What they do is they take your money and then they invest.
Yeah, they invest, but there's a rate that fluctuates minimally.
Yes, so there's a slight rate that fluctuates, right? So they will announce the rates,
Yeah.
From time to every on a yearly basis or sometimes on a quarterly basis. Just like a big company, they will announce what is the dividend rates, right,
Yes.
for that particular quarter.
Correct.
And then dividend rates generally they reinvest the dividend rates.
Okay.
So if you want, you can take it out, but because the amount is so minimal, right? You don't really want to take it out, so you
Just leave it inside.
Just leave it inside. Then
Regrows and grows and grows.
It grows and it compounds over time.
Correct.
So
Correct.
unit trust is one. Low risk, of course, low returns, but it's safe. Very,
It's safe.
very safe.
You don't have to worry something collapses that easily.
Yeah.
And if you are a Bumiputra, they have the Amanah Saham Bumiputra.
Yes.
All right. That one,
Give a slightly higher rate.
it's
But
that one.
it's limited. That's limited.
That one is limited, so I think you can only put in about 200 to 250,000, and it caps there. The rates are slightly better, but the unit, the entry unit is the same. It's always one ringgit.
Yes, it's always $1.
Whereas, like I think Amanah Saham National, Amanah
fluctuates a little bit.
Saham Wawasan, there's a slight fluctuation,
Yes.
few cents. So, like I said, it operates a bit like a share, but there's minimal fluctuation.
Yes, correct.
Yeah, so you can choose to do either side. And if you are Bumiputra, you already finished that side, you can go into ASN.
Yes, you can.
You can also go to ASW.
Yes,
Yeah,
correct,
so
correct,
so don't worry, there's a lot of options like that.
Yep.
Now, how about the other unit trusts by banks?
Now, unit trust by banks, I would say it's a bit risky.
Risky?
Yeah, I don't generally like unit trust by banks.
Okay.
Because they are not as transparent. They're not as transparent as Amanah Saham.
Okay.
So Amanah Saham is like more transparent. You can view their reports and all, right? But the banks ones are not that transparent, and the returns are not that good compared to Amanah Saham.
Yeah. That one would really fluctuate a lot by
Yes.
market rates.
Yes, it
by
fluctuates a
market
lot.
rates. So if your markets are
Yes.
moving very wide, your bank-backed unit trust may give you really
May
good
give good
returns on
returns.
certain years, but
May
it
give
may not
bad
give you
returns.
much returns on others.
Yeah.
And there's a possibility it might even go negative.
Yes, and
Yeah.
because of that, I don't recommend, especially if you're going to be putting money and you're not monitoring it.
Yeah.
I would
Yeah.
say, put in something safe.
Put in
Right? So
something
lazy
safe.
investment is all about safe.
Correct.
All right.
Keep it safe.
Yeah.
Right. The next one.
The next one is managed funds.
Managed
right?
funds.
Managed funds.
Right.
Right. Now, there's a lot of funds in the market. Tons of them in the market. A lot of funds are run by banks, are run by financial
Investment
institutions,
house,
right? I think you also put some
Yeah.
some
I put
investments
some.
in.
I put some into Kenanga.
Yeah.
All right.
So-
So that's an investment fund.
Yeah, so you have all these investment firms. They have their own investment funds, or they can introduce you to other investment funds locally or internationally. So depending on your appetite of your risk
appetite.
all right.
Yeah.
So they have they have low risk, medium risk, and high risk.
Yep.
So high risk basically fluctates a lot.
Correct.
Low risk fluctuates very little. Medium risk fluctuates in between.
Yep.
So managed funds can give you on a yearly return if it's low risk, and again it's like Amanah Saham anywhere between 3 to 6% per year.
Yes, about that.
Yeah. Medium risk can easily get you about 6 to 8%.
6 to 8%,
Yeah.
correct.
And then high risk, of course, anything 10% and above.
8 and above.
Yeah, 8 and above. It's
Yeah.
high risk. But one of the good things is someone is managing for you. A professional is managing for you. You get updates on a regular basis,
Yes.
just sometimes on a monthly basis to
Correct.
see how it's doing.
Correct.
And what you do is you just put your money in and just leave it there.
Yeah.
Now, some funds have maturity dates. That means after
Correct.
you put in,
Correct.
let's say after
Correct.
5 years,
Yes.
then the fund ends.
Yes.
All right, the fund ends, then you
must cash out.
Yeah, and you must cash out. Some funds have no expiry dates.
Yes.
So it goes on forever.
Perpetual.
Yeah, it's perpetual. So it's up to you which one you want to put in. Some people want to put in for those with maturity dates because generally those are slightly higher risk. They usually
correct.
take these funds and invest in slightly high, I would say in slightly new young companies, which give you slightly better returns.
Correct.
So again, it's up to you lah, which one you want to choose.
Yeah. But again, it all falls in your risk appetite. Is that money going to be used or not? Are you just going to watch it grow or not actually watch it?
Yeah.
You're just going to put it there and let it grow, or there's a chance that you might want to take it out.
Yes.
Because if there's a chance that you might want to take it out, then having that fluctuation may not be your appetite.
Correct.
May not be in your appetite. May not
Correct.
be in your best interest also. Because and also if you're the type who gets fidgety. Yeah. So lazy investment, right, is for people who don't fidget.
Who don't fidget. No. Yeah. No.
You
I would
fidget
say
minimally.
No. I would say lazy investment, right, is great for someone who panics easily. Or who panics easily from price fluctuations.
Okay.
And they can't take the stress from price fluctuations. So they like to put into very minimal risk investments. There are, of course, some people who are high risk investors. You know, they like that. You know, on a per day basis, a share price can fluctuate 5 to 10%. You know, for them, they live for it. The thrill is there, but a lot of people can't take it. Right.
And I think for that sense, the lazy investment might be your appetite. And that's my appetite. You know, just lazy and just put in and don't think about it.
Now, I would say the third one is my favorite, and I'm actively investing in it. All right, the third one is actually index funds.
Index funds.
Now, what is index funds? So basically, index funds are usually funds set up by large investment companies.
All right,
and they track the stock market of the country. Example,
KLSE.
Yeah, KLSE. Right? It tracks KLSE.
All right.
So when KLSE goes up 1%, the index fund goes up 1%. It correlates. When it goes down 1%, it goes down. Then the index fund goes down 1%.
So you're not buying a company. You're buying the
entire economy. Yeah, the entire economy.
You're playing with the country's economy.
Yes, exactly. So when the economy does well, the stock market goes up. The general stock market goes up. Your index fund goes up. Now the reason why index funds are very safe because in a particular stock market can have anything between 1,000 to 10,000 companies.
Yes.
So you are betting on all the companies. So if one company drops,
it's okay.
Doesn't actually affect your fund at all. One company goes up, doesn't really affect because it's the market that moves. Now, one of the best index funds, I would say the highest, the most research and the most data is actually the S&P 500, which is US, all right, the New York Stock Exchange. Now, S&P 500 means that they track 500 of the top companies. So the 500 companies will change from time to time. But there is a track record of 100 years whereby the index fund, if you buy the index fund, it gives you back a 10% return. Year on year.
How does anyone get into it? They talk to their...
So you can talk to your stockbroker or your bank. All banks have it these days, right? Last time it was very difficult to buy. You have to open an account with an investment firm, you know. But now all banks have it. Talk to your bank and tell them that, hey, I want to buy an index fund. Which country? Malaysia, US, Hong Kong. You can buy Hang Seng. You know, you can buy New Zealand as well. So you talk to them, and they would show you the way. Show you how to do it. Either they will help you do it, or you can do it yourself. Right? Buy it and leave it there. All right? Buy and leave it there. Now, the reason why is this: it gives you back a 10%. Year on year.
That's really good.
It's a lot.
It's really good.
It's a lot. And if you compound interest, right? If you do compounding interest, right, means that if you start putting in at the age of 30, all right. Let's say you put in just 10,000 at the age of 30, and you don't put in anymore, right? At the age of 60, generally, you will actually triple to quadruple your initial investment. Triple to quadruple. It means that 10,000 becomes 30,000 to 40,000 when you retire. Now, if you put 10,000 and on a monthly basis you add in just a few, let's say you add in only 1,000. What happens is at the end of 30 years, right, you actually make a lot of money. All right, you can even hit millions. All right, just by putting a little bit,
because the 10% gets
compounded. It gets compounded. It gets compounded, and it's not like your unit trust, or neither is it like your your managed funds, whereby the interest only comes in on a yearly basis. This one is on a daily basis. It's compounded
daily basis
because
the fluctuation,
because the market grows every day. Goes up, goes down, goes up, goes down. So it fluctuates on a daily basis. So because of that, the 10% is actually much better.
But how do you see the 10%? You know, if you say it's 10% a year, means,
let's say you put in 10,000.
No, that means what? The index is going to be going up 10%?
Yes, the index generally goes up on the 10% per year.
But then there will be fluctuations. Right?
Yes, there are times where it drops and there are times it goes up.
Okay.
So let's say in 2020 and 2021, the the US market went up on average 15%.
Okay.
15 to 18%. I think the Nasdaq, which tracks the tech stocks, that one went up 15%.
Okay.
S&P 500 went up 12.5%.
Wow.
So of course, this year 2022 it did badly, is down 20%. But again, if you look at historical data, you calculate, you average out. The law of average. The law of average is a 10% year on year with recession. With recession.
That's good.
Yeah. So put in money, a little bit here, a little bit there. Put it on a monthly basis.
I'm choking on how much money he's making.
Yeah. No. So one of the tricks, right, with lazy investment is this: set aside additional funds. All right, means that you
Add in every month.
Yeah, you put it on a monthly basis. Let's say you take your salary. All right, take roughly about 20% out of it. Don't put 50%. Don't put too much, right? 20%. The reason why if you can afford 50%, then put 50%. Why not, right? So whatever money that you can afford, put it aside, all right? And then that money, just put it in. Does not matter if the market is up or the market is down. Just put it in, right? There is a trick called DCA, all right, which is called what is it called again? DCA is something average. It's not discounted cash average.
Daily.
No. Man, I need to Google it. Man, my phone's on the other side. Okay, so you DCA. Okay,
you talk. I'll Google.
I forgot the term of it. Okay, so you DCA, right? DCA means that you don't care what price it is. As you put in, it
dollar cost
average. Yes, it means it just averages it out, right? So you DCA, just put it in. Don't care whether the market's up or market is down. Okay. So, funny thing, right? People like to time the market.
Okay.
Everyone loves to time the market.
Right.
Everyone thinks that if I buy when the market is low, and then when I cash out when the market is high, I make the most money. So they actually did a study again. Right? They tracked 3 people.
Okay.
Right? 3 people over the course of 20 years.
Right.
20 years. Person A bought when the market is at the lowest.
Okay.
Person B bought when the market was at its highest.
Okay.
All right. And person C dollar cost average on a yearly basis.
Okay.
All right. On a monthly basis.
Okay.
All right. What they did was they put in the same amount.
Okay.
All right. Everyone put in 100K.
Okay.
All right. But the person C dollar cost average means that every couple of months they will put in a little bit more money. All right. What they did was when they tracked all 3, they realized that the one that made the most was actually the one that dollar cost average.
Every day, put in.
Dollar cost average with buying at the lowest was actually the same rate. That means that if you time the market, if you're lucky, you can time the market. But most people cannot time the market.
Yep.
It's impossible.
It's possible.
It's gambling. So if you time the market versus dollar cost average, you actually get the same return. And if you buy when the market is highest after 20 years,
it averages out.
It is actually only 10% lower.
Oh.
So it means that end of the day, right, it does not matter when you buy.
So it's more important to have the discipline of doing it on a regular basis.
Yes, it's very important to buy regularly and just keep it there. Don't touch it.
And if only your agents tell you all this.
Yeah.
They're not very smart, huh?
Yeah. So, index funds or there are some ETFs, go ahead and buy. Generally, they are very, very safe. So these are the 3 lazy investment tips that I have.
Right. I don't have much, but if you're damn lazy, right, your EPF is also another.
Yeah.
Your EPF is a very good lazy investment.
So, EPF actually is a managed fund, right?
Correct.
Because money is inside.
Yep.
All right. It does not have a maturity. So it actually has a maturity date. At the age of 60, you have to take it up.
Not have
55,
to. Not have to.
It's not have to, but at the age of 60, you're
allowed to withdraw.
You are allowed to withdraw.
Now,
what they do with your funds is they take it and then they invest in companies.
Correct.
Yeah, they reinvest it. So they have professional fund managers to actually invest the money, your money, all right? And historically, EPF has given us roughly a 4 to 6% on a yearly basis.
Correct.
Right? If you average out, it's roughly about 5%.
Correct.
Which is, end of the day, as good as most unit trusts.
Correct. And this is as risk-free as
as risk-free as possible.
You don't need to even monitor. And the best part is you can't even take it out.
No. So
you can't even take it out.
So there is a fear. What if EPF collapses? Now, the fear is unfounded and it's dumb. You know why or not? If EPF collapses, means that the whole nation is on
which means
collapsing.
his index fund also gone.
Means that if one country collapses, right, it's a domino effect. All the countries will collapse, and whatever money you have in investment or your stocks or your house property is zero already.
Yeah.
So EPF will never collapse, right? The reason why if it does collapse, the entire region and the whole world will collapse. So that's the thing with sovereign funds is generally it doesn't collapse.
Correct. And as long as the country wants to continue on its growth chart or just to be in existence, it's gonna have to be there. But there were a lot of fears. Let's be fair. Every time it comes to elections and all this, and when people talk about the geopolitical scene, EPF and Amanah Saham comes into play.
Yes.
Everyone starts panicking.
Yes.
They start
correct.
withdrawing.
Trust me, if you do withdraw from EPF, you're actually losing out.
Yeah. It's a good money.
It's a good place to.
It's good lazy money.
It's a good lazy investment, right? And the reason.
Can you top it up?
Yes, you can top it up.
As in, like, I'm an employee and I want to top it up.
Yes, you can actually request from your employer to increase your
contribution.
Your contribution.
Okay.
Right? You can talk to your employer, and then I think there are certain forms that you have to sign, which is from EPF to increase your contribution, or you can actually do a self contribution. That means that you can walk into any EPF office and you tell them, hey, I want to cash in. I want to put in more cash into my account. Yeah. If not mistaken, per year is only 60,000 maximum.
Okay.
Because they do not want people to
misabuse
and use it as a bank to keep money and get 6% per year. It's a lot, 6% per year. I think now banks are only giving you like 2% only.
What? That's FD.
FD.
When you put in your savings, it's nothing.
It's like
savings
like
0.1%, 0.4%.
Yeah. So they want to prevent people from abusing the EPF system, so they limit. So it means that it is so good
that they don't want
your cash. They don't want any of your money.
They've already taken your money
Yes.
on a monthly basis, and you
want
want to
anymore.
top up. They don't even want so much of it.
They don't want anymore.
So think about it.
Yes.
Think clearly, because who doesn't want to take your money?
Yes, who doesn't? You walk to any bank, right?
You walk to any investment house.
Yeah,
I got another 60,000. I got 100,000. They'll be so happy to take it. This one only wants to take 60,000 and limits you. Finished, gone.
Yes.
And decent. 60,000 basically means about 5,000 a month.
It's a lot.
It's a lot. So if you've got that windfall for whatever it is, dump it in if you can.
Dump it in.
And 60,000 a year again.
60,000 a year.
DCA on a year-on-year basis.
Yeah, on a year-on-year basis, right? 60,000. On average, when you put in, right, you will end up with a lot of money. If you don't believe me, right, you go to any compounding interest calculator online. You put 60,000 per year, and you just put 6%, and then you just click.
Okay.
It shows you.
If you're talking about compounding interest, there's one very interesting statistic. It's a 10-7 rule.
And what is it?
So 10-7 rule says that if you have a 10% compounding interest, and you don't put in any more money,
yes,
on the 7 year it doubles.
Yes, correct.
And same thing, if it's a 7% compounding interest, on the 10 year it doubles, and that's not putting in any money yet.
Yes, correct.
So think about it. If you manage to get those kind of returns, you put in index fund 10%, 7 years, your 30,000 becomes 60,000.
Yep.
So that's pretty good tips.
Yeah, those are actually very good tips. And a lot of people don't have time, so this is the best lazy investment. Yeah. So let us know in the comments what other lazy investment
that you have or you've done,
that you have done or that you have actually heard of.
Or you can even ask Dr. Ingky.
Right,
are these considered lazy?
I'm not qualified to give you financial advice. So sorry.
Just He'll do some research and he'll tell you. He'll just tell you lazy, not lazy. Yeah. The rest you find out yourself. So anyway, until then, we'll be back again with other topics. This is us signing off this week, and we are talking about lazy investment. See you next week.